If you have $1,000 sitting in a checking account right now, you are losing money every single day. By the end of this year, inflation will have removed enough purchasing power from that cash to buy a full week of groceries. Most people believe building wealth requires an initial $50,000 and a specialized finance degree. In reality, those are barriers to entry that don't actually exist for the modern investor. Today, we are breaking down the 10 specific steps to take that first $1,000 and turn it into a self-sustaining system. If you watch until step 10, I will show you the exact mathematical threshold millionaires use to ensure they never run out of money, regardless of what the stock market does. This chart shows why the big banks are a leak in your budget. The average savings account pays 0.01% interest. Moving that same cash to a high-yield savings account pays closer to 5%. On a $1,000 balance, that simple move converts pennies of yearly interest into $50 of free cash. Relocating your baseline savings is the first requirement to stop wealth destruction and begin generating passive growth. Before you buy a single stock, you need protection against sudden financial impact. Step 2 is establishing a $1,000 starter emergency fund. $1,000 is the specific threshold that covers the majority of common emergencies, like a broken laptop or a car repair. Without this cash on hand, these events force you to use credit cards with 24% interest, which can instantly stall your progress for months. To grow your wealth, you need a surplus of cash. Step 3 is an audit of your recurring expenses. Rather than cutting out small daily joys like coffee, look for automated drains like streaming services you haven't watched in months or app subscriptions you forgot to cancel. Finding and cutting just $83 a month in wasted subscriptions generates an extra $1,000 a year in investment fuel. A secure emergency fund combined with optimized cash flow creates the defensive perimeter necessary to begin market investing with confidence. Step 4 is utilizing index funds. This strategy involves buying a tiny piece of the 500 largest, most profitable companies in America all at once. If one company struggles, the other 499 provide the stability to keep your portfolio moving upward. Step 5 modernizes this via exchange-traded funds, or ETFs. These allow you to buy a diversified basket of stocks instantly for the price of a single share, often $100 or less. It provides the same diversification as a traditional fund, but with lower costs and immediate access. Standard brokerage accounts trigger capital gains taxes on your profits. This means as your wealth grows, the government claims a significant portion of your lifetime earnings. A Roth IRA functions as a legal shield against those taxes. You pay tax on the money you contribute today, but every dollar of growth and every dividend earned inside that account is 100% tax-free for the rest of your life. Holding low-cost ETFs inside a Roth IRA creates a mathematically efficient environment where your money can compound without being eroded by taxes. Relying on monthly discipline to invest manually is a strategy that often fails. Step 7 is removing human emotion by building an automated system. By setting up an automatic transfer on payday, money moves directly from your paycheck into your investment account before you even see it. This ensures your future is paid for as a non-negotiable priority rather than an afterthought. I'd love to hear from you. What was the very first investment you ever bought? Or what is the main hurdle stopping you? Let's talk about it in the comments below. Step 8 is focusing on dividend-producing assets. When you own shares in large, profitable companies, many of them distribute a portion of those profits back to you every quarter. This is genuine passive income, your money earning its own paycheck. Reinvesting those dividends allows your portfolio to grow exponentially. This automated cycle removes the need for active daily management while your assets continue to accumulate. There is a hard mathematical limit to how much you can save, but your ability to earn is theoretically limitless. Step 9 is focusing on your income potential. If you earn $40,000 and save 10%, you've put away $4,000. If you use your time to learn a high-income skill like coding or data analysis and reach a $70,000 salary, that same 10% effort now puts $7,000 into your accounts every year. Step 10 is maintaining a long-term perspective during market volatility. When the news is screaming that the market has dropped 20%, most people panic and sell. Sophisticated investors treat those drops as a discount on their favorite ETFs and continue their automated buying. This strategy leads to the 4% rule. Data shows that once your portfolio reaches 25 times your annual expenses, you can withdraw 4% of that total every year. Because the market's historical growth exceeds that rate, you can live off the growth indefinitely. Financial freedom is reached at the exact moment your investments generate more growth than your lifestyle requires. It is the result of consistent application of these 10 steps over time. To recap the defensive steps, move your cash to a high-yield account today, secure your $1,000 shield, and audit your monthly subscriptions. Then, execute the growth plan. Use index funds and ETFs, protect them with a Roth IRA, automate your transfers, reinvest your dividends, increase your earning power, and follow the 4% rule. Your next step is to buy your first asset without paying unnecessary fees. In this video on your screen, I walk through a screen recording of exactly how to buy your first ETF in under 5 minutes. Understanding the blueprint is the start, but following this specific order of operations is what creates lasting financial stability. Click that video and let's get to work.